Okay, let's start our session. So today we are going to cover IAS 1, the presentation of financial statements. Okay, so some ground rules. Always mute your mics so that we can avoid some background noises. If you want to ask something, that's when you can unmute. Those are the ground rules. Normally, we should start our sessions exactly at 1900 hours, that is 7 p.m., so that in 2 hours' time, up to 9 o'clock, we will be done. So I will just forgive you for today, since we were having some problems joining and connecting, but tomorrow, this is a recurring meeting. So once it's 5 minutes to 7 or 10 minutes to 7, you can join the session using the same link. Or I will also add all your emails to the invite so that you can just accept, and it will notify you every day 30 minutes before the session. So I just want someone or everyone to confirm if they can hear me clearly and if they can also see the slides that I'm presenting. Tsitsi Pamela. Okay, that's fine. So, okay, that's fine. So, the presentation of financial statements, that's IAS 1. So, some little bit of a background. I don't want to get into too much detail on IAS 1 because some of the things are not at your level. You just have to know what the standard talks about, the general format for a statement of profit and loss and other comprehensive income, the general format for a statement of financial position, the general format for a statement of change in equity, and also the general format for the statement of cash flow. Of course, statement of cash flow is covered by a separate standard, which is IAS 7. So we are not going to cover much on the statement of cash flow. The statement of change in equity is simple. So we are not again going to cover much on that one. What we are going to cover is the first one, the statement of profit or loss and other comprehensive income, and also the statement of financial position, also known as the balance sheet. Okay, so it's saying some little bit of background on IS1. IS1 sets out overall requirements for the presentation of financial statements, guidelines for their structure, and minimum requirements for their content. It requires an entity to present a complete set of financial statements, at least annually, with comparative amounts for the preceding year. Okay, I will show you what it means. So we normally have 5 financial statements. A complete set of financial statements is comprised of, the first one is the statement of financial position as at the end of a period. That is the balance sheet. You can call it a balance sheet, but nowadays companies normally call it a statement of financial position. Number 2, we have the statement of profit or loss and other comprehensive income. You can also call it statement of comprehensive income. Then the third one, we have the statement of change in equity for the period. Then the fourth one, we have the statement of cash flows for the period. Then the fifth one, we have the notes. Forget about this sixth one. So we have the notes. Those are the 5 financial statements, or those comprise a complete set of financial statements. So we said the first one is the balance sheet, and then the second one is the statement of profit or loss, the third one is the statement of change in equity, and the fourth one, then the fifth one are the notes. Okay. This you can read all this, the scope, then all these ones. I don't want to concentrate more on the theoretical part. I want to concentrate on how you can work out a question asking about IAS 1. So normally what they test is it's not like IAS 1 is difficult, but if you cannot manage your time well, you might end up answering only IAS 1 in an examination setup. So you should be able to manage your time very well. At most, you should spend 30 minutes answering IS1. It's very simple by practice. With practice, you get to that. Okay, so the format for the profit and loss account is very summarized. So what you start with your revenue. Normally, IS1 requires that you also present comparatives. So if we assign comparatives, let's say this year is 2003, like in this case, 2003 year, you should also present amounts for 2002. So the amounts for 2002 are the comparative amounts. Okay, so we start with revenue. This is covered by IFRS 15. It used to be covered by IAS, how do you call it? IAS 18. But now there is a new standard, which is IFRS 15. Then you put your figure here. Then you also put the comparative here. Then the cost of sales, not covered by any standard. You know that your cost of sales is open inventory plus purchases minus closing inventory. Then you can also add the carriage, once they are there, and all those other things like depreciation of plant, you can add those to cost of sales. Then the difference between the revenue and the cost of sales, obviously, is the gross profit. After the gross profit, you add other income. Here we are talking about profit or loss on disposal of assets. We are talking about interest received. We are talking about all other income that you can think about. Then before you actually calculate, you put your other income here. Before you actually add the other income, then you put the distribution costs. All the costs that are related to distributing your goods or services to the customer, you classify them as distribution costs. Then you put administration costs or costs that are administrative in nature, like, for example, rentals, for example, depreciation of office equipment. Those are administrative related. Then there are some costs that you cannot classify as distribution or as admin. Then you can then classify them as other operating expenses. So in this statement, according to IS1, if you are going to prepare financial statements that are suitable for publication, I will explain what I mean by that. You should categorize your costs by function. And in this case, by function, we are saying you should classify your cost as either distribution or admin or other. You don't put like a line item to say rentals here. No. If rentals is administrative related, then you classify it as admin. If you can't classify it as distribution or admin, then you can classify it as other operating expenses. We only want to see those three line items for expenses. Okay, so you put your admin here from 2003 and also 2002, you put your other and you also put your distribution. Then you find your profit from operations. Here, the cost, of course, we are deducting them. The expenses, we are deducting them. So for the admin, the distribution, the other operating expenses, we are putting them in brackets because they are expenses. They are using our gross profit and other income. Okay, then we put finance charges. These are the interest from loans and also interest on preference shares dividends, provided those preference shares have been classified as loans. You know, normally preference shares, dividends on preference shares, they are finance charges. But if it is a non-redeemable, non-accumulative preference share, it becomes equity. So in that case, you don't put the finance, you don't include it in the finance cost. Rather, you account for it in the statement of changes in equity. Then forget about this one. I want to believe that now you are not doing consolidations. You do consolidation in part 2 too. So forget about the share of profit from associates. After the finance costs, then the amount that you are going to get will be the profit before taxation. Then you put your income tax. This is coming from IAS 12, income taxes. Then you put it here in brackets, then the amount that you are going to get is the profit or loss for the period. Then there is, because this statement is called the statement of profit or loss. So what we have calculated up to this amount is the profit or loss. Then it goes on to say, and other comprehensive income. So it's like two statements in one statement. We have the profit or loss account, then we have the other comprehensive income account. So what we put in the other comprehensive income account is those things like those things that are not really trading activities, like revaluation of assets. That one is not a trade like. So when you have a revaluation gain on the revaluation of assets, that gain, you don't put it in this other income. No, you rather put it under other comprehensive income down there. Okay, so I have another example here. After calculating profit after tax, which is this one, you are now going on to say other comprehensive income. It's like a subtopic. Then we have revaluation surplus. As you can see, we have share of other comprehensive income, joint venture. Forget about this one, is related to consolidation. Then we have cash flow hedge. This one is IFRS 9. Then we have IFRS 9 also. Let's say we have financial instruments that we are holding or maintaining through other comprehensive income. You can also put those here. I will show you what it means. So IS1, in order to actually tackle IS1, well, we should be knowing all the other standards, because if it is PPE, they are going to just put a note about PPE, and you should know how you account for PPE using IS 16, property, plant, and equipment. If there was an impairment, you need to assess the impairment using IS 36, impairment of assets. If there was a provision, you should know that you classify, how do you account for a provision in terms of IS 37? If it is investment property in terms of IS 40, I'm not sure if you are doing all those standards, but as long as you did PPE, you should do those other assets because they are related to all those other standards because they are related to PPE. I want to believe that you are also doing borrowing costs IS 23, changes in foreign exchange rates IS 21, and then government grants IS 20. Maybe if you are not doing those, just forget about those ones. But for IS1 purposes, you should be very aware and comfortable on all those standards because they're not will be just mixed up. You will see, we are going to do an example. You will see what I am talking about. Okay, so that's it on the statement of profit or loss and other comprehensive income. What you need to understand very well is that the name that you put is let me just try to find my eraser. Where is my eraser? Here, so that I can rub off these ones. Okay, so how do you put it? The important things here, you say, you put the name of the of the company on top. Like in this case, let's say Nitt-Gritt Private College, that's the name of the company. Then just forget about this one. Then you say statement of profit or loss and other comprehensive income. For the year ended 31 December, that's what the actual mark. The first thing. The first thing is to put the name of the company on top, the full name. If it is Nitt-Gritt Private Limited, it's Nitt-Gritt Private Limited. If it's Econet Wireless Private Limited, it's Econet Wireless. If it is Edgar Stores Limited, it's Edgar Stores Limited. You put the whole name, then just below you put the name of the account that you are preparing. In this case, you are preparing a statement of profit or loss and other comprehensive income for the year ended. You have to be very specific year for the year ended, then whatever year, if it is this current year or 2020, you say for the year ended 31 December 2020. It's different when you come to the balance sheet. The balance sheet, you don't say for the year ended, you say as at, the balance sheet as at. It's very important that you put those things. Okay, so that's it for the profit and loss account and other comprehensive income. What you need to know, you summarize cost of sales. You don't like put the whole note there to say opening vendor blah blah blah. You work those ones in the notes. Then here we only want one figure. The sum applies to revenue. The sum applies to other operating income. You don't list them in your statement. You rather put a note. Say if it is operating income, you put note number 1. Then you can work out those other income in note number 1. Here we only want to see one figure. The sum applies to all those things. Let's go to the balance sheet. The balance sheet didn't change much. We just say our assets, and then we start with the non-current assets. So property, plant and equipment, this is in terms of IAS 16. You don't put like all the assets to say if we have buildings, you put buildings, you put plant and equipment, you put fittings. No, you disclose that in the form of a note. So here we just want to see one figure related to PPE. Then you can then say working number 3. Then on the working number 3, you put the PPE note. Okay. Then numbers to goodwill. This one you put it separately from PPE. And then we have investment in other companies. Forget about those ones. Then we have investment in equity instruments. These are financial instruments. I want to believe that you are doing IFRS 9. Then other intangible assets, like we have patents, trademarks, softwares, and whatever certificates. You put them under other intangible assets. So you know that in the past you used to put like how many columns? You would put many columns. You would put 3 columns. Then you say cost, deep, net book value. No. We no longer do those things. You work out those things in the notes. Then here only want to see the net book value. So this 5550 is the net book value. Okay. Then we go to current assets. Nothing there. Inventories is IAS 12. Trade receivables is IFRS 9. Cash and cash equivalents is just cash and cash equivalents. Then we have total assets. Then we go to the other side where we have equity and liabilities. Okay, so on the equity and liabilities, you list your share capital and your reserves. Then after equity, we go to non-current liabilities. That's where you put your long-term borrowings, your deferred tax, which is in terms of IAS 12. Long-term borrowings is in terms of IFRS 9. Then current liabilities, you put retained payables, which is IFRS 9. Then the current portion of long-term borrowings and all other the accruals and all those things, you put them under current liabilities. Then you total your liabilities and your equity. This one should be equal to this one. Then your balance sheet balances. Okay, that's it for the balance sheet. Not much changes. Then we go to the statement of changes in equity. You say for the year ended, the name. As we can see, I said the balance sheet, the statement of financial position is it. But then the profit and loss account, you say for the year ended. And also the statement of changes equity, you say for the year ended. Even the statement of cash flow, you say for the year ended. For the year ended, I want to believe that you can see. I know that the figures are too small. Okay, so the statement of changes in equity, we are actually putting all your share capital and equity and reserves. So here we have share capital, we have revaluation reserve, we have cash flow hedge reserve, the retained earnings. Let's end here, forget about this one. This is related to consolidation. Okay, so what you do is you say the balance is at the beginning, or let's just say opening balance. You put your opening balances. This would be maybe in the trial balance or whatever on a note. Then if there was correction of any error in terms of IAS 8, then you put the correction. Then that's the correction here. Then you calculate the restated balances. You just say the opening balance plus the correction or minus the correction. So this will be the restated balances. Then changes in equity, you are now, if we had new issue of shares, you put them here under share capital, here under share capital. Then if you have redemptions of shares, you put them here under retained earnings, depending whether we were utilizing retained earnings to redeem the shares or whatever, or we are using revaluation reserve. Then if we had bonus shares, we put them. If we have acquisition of subsidiary, forget about this one. This is related to consolidation. Then if we had paid dividends, then you put here under retained earnings, because of course we can only pay dividends through retained earnings. Okay, then you add the restated balances with these changes, the changes here, to find out the closing balances, which are these ones. Okay, so that is a calculation for you will see when we do an example. This is quite simple. Then the statement of cash flow, this is in terms of IAS 7. So we are not going to cover this, but for examination purpose, I don't think they will ask you about the comparatives. You only need to calculate for a single year. So you can actually forget about the comparatives, just disclose for 1 year. But for learning purposes, I just show it to you how you can work around with the comparatives. The comparatives, I was saying, if you are in 2020, you should also disclose for 2019. So all the values for 2019 will be the comparatives. Okay, so that's the theoretical part of IAS 1. So before we actually do an example, do we have questions, or I've actually lost you? You're too quiet. Do I have people here?
Yes, so far so good, no questions.
Okay, what about the others, Pamela? Tsitsi?
Yeah, we're following. So far so good.
Okay, that's brilliant. Okay, that's brilliant. Yeah, I can hear that you are breaking and you know, but it's fine. The recording will always be available if you are not like following because of network problems. Okay, so let's now attempt a question. Where is my question? Yeah, let me open the question. Just a minute, the question is opening. Okay, this is our question. I just hope. Yeah, this is our question. Okay, so let me minimize this. Yeah. Cut what is happening. Okay, whatever. Let's do our question here. So before we do the question, what did I want to do? Okay, so we are going to do this question. This sundown question. Is it not responding? Okay, so the following trial balance relates to sundown. This is a typical examination question. So pay attention. The following trial balance relates to sundown at 3rd September 2009. So this is a trial balance. You know that we have the credit side and the debit side of a trial balance. So we have revenue. So I think a good trick is actually to say when you read the question in full so that you understand it. Then you read the requirements after reading the question. Then you repeat reading the question, and when you are now repeating, you are actually working out your notes. Okay, so I will be doing my workings here. So on the first tab, I will put the statement of profit or loss and other comprehensive income. On the second tab, I'm going to put the statement of financial position. Then on the third tab, I'm going to put the notes. Okay, if we have other requirements, we can always refer to those. Okay, so where is the question now? Okay, so it's saying the first line item is revenue and it's referring us to note number 1. So let's go to note number 1. So note number 1 is saying the following notes are relevant. Note number 1, Sundown's revenue includes 18 million for goods sold to pending on 1 October 2008. The terms of the sale are that Sundown will incur ongoing service and support costs of 1.2 million per annum for 3 years after the sale. Sundown normally makes a gross profit of 40% on such servicing and support work. Ignore the time value of money. So this is a typical note. It's talking about revenue. So here our revenue figure that we have here is 380,000. It's like 380 million because we have all those zeros, but let's forget the zeros above. Let's concentrate on the amount that we have here. So we have 380,000, and they are saying out of this 380,000, it's actually 380 million. They are saying out of that 380 million, there is a 16 million for goods sold to pending at the beginning of the year. That is because our year ends at 3rd September. So it would have started on 1 October last year. So as you can see here, they said our year end is actually this one, and then the sale is being made on this date. So it's actually at the beginning of the year, of our current year. And they're saying the terms of the sale are that Sundown will incur ongoing service and support cost of 1.2 million per annum for 3 years after the sale. Then we are told about the gross profit margin. So what is they are testing you on this note is whether you are able to apply your standard. And in the past, when this question was set, we were still applying IAS 18 revenue. But now that standard is absolute. It was withdrawn and replaced by IFRS 15 revenue from contracts with customers. So maybe you actually need to know both, but IAS 18 was simple to apply. If it's 9, if it's 15, there are some complications there, but the principle always remain the principle. So what does IFRS 15 say? Saying it says you can only recognize revenue. So let's do note number 1. Okay, so our note number 1, we are going to discuss revenue. In examination, that's what you actually do. Okay, so you are going to say our total revenue. We are told that the total revenue is 380,000. This is the total revenue per question. Then they are saying out of this 38,000, there is 16,000 according to our notes. And for this 16,000, the terms, there is a term, the terms of the sale are that Sandown will incur ongoing service and support costs for 1.2. So he is going to incur 1.2 for the ended 3rd September 2009, and also the next year, and also the next year after the next year, for that to make it 3 years. So as at the end of the current year, which is at this date, we've actually satisfied the first service. Because here, what is happening here? We have 3 years. How many years do we have? Let's go to. We have 3 years here. We have year ended 2009, year ended 2010, year ended 2013. So they are saying this guy should incur 12,000 here, 12 million. Let's ignore the other zeros. 12,000 here, 12,000 here. That's or let us just put all the zeros to make our life simple. Okay, so that's what they are saying. These are service costs, ongoing service. I need to. Is this 1.2 million? Yes, that's 1.2 million, not 12 million. They said 1.2 million instead of 12 million. They said the ongoing costs are for 1.2 million. Okay, that's this one. Okay, so per annum, beginning from the current year up to the 3rd year. So that means we are preparing our accounts as at the end of 2019 here. So that means we would have satisfied this one, the first 1.2. So the balance that we actually have as at the end of 2009 will be the 2010 balance and also the 2013 balance. So in total, we still owe these two balances, which are adding up to 2.4 million. So we cannot recognize the 2.4 million because we haven't actually satisfied the performance obligation in terms of IFRS 15. And IFRS 15, specifically IAS 18 that was talking about revenue in the past, it was saying you defer the recognition of this 2.4 million and you also add a markup. That's why we are given this note that is saying Sundown normally makes a gross profit margin of 40%. So if you are given a margin, you know how you calculate markup, isn't? Yes. So if we are saying margin is 40 over 100, you know that markup will be 40 over 100 minus 40, isn't it? That will be our markup, isn't it? Yes, that will be our markup. So if we do that, it will be actually is equal to 40 over 60. So this is our markup. So our markup is actually 67%. That is our markup. So before we actually, I want to calculate the amount that we are going to deferred income in a way. So we are saying the 2.4, which is the addition of the amount that we are going to incur in 2010 and the amount that we are going to incur in 2013. We should add a markup of this one. So the calculation will be as follows: the 2.4 plus the 2.4 multiplied by the markup. So it's actually 4 million that we need to defer. So instead of recognizing revenue of 380,000, specifically the 16,000, because for this specific contract, the total contract amount was 16. The total contract amount was 16,000. But the 4 million that we have actually just calculated, we have to defer it in terms of IAS 18 or IFRS 15. So what we are going to do, we are going to say less this amount that is going to be deferred, 4 million. In this case, let's put 4,000 because we have ignored the zeros. Okay, so we're going to put 4,000. We are ignoring the other three zeros. Okay, so let me just delete this. So we say deferred. You see how I calculated this one, deferred income. Okay, so here revenue recognized. So that means we're going to recognize revenue of how much? The 380 minus the 40. So we're going to recognize revenue of this much for the year ended 2009, September 2009. So that will be the note for revenue. So when you come to your statement of profit loss here, let's just say statement of profit or loss and other comprehensive income for the year ended 30 September 29. We said you should put the name of the company. In this case, it's Sundown. Okay, so this is how you do it in an examination setup. Okay, so what we are going to start with actually is okay, so we're going to start with revenue, isn't revenue, and we've calculated our revenue. Okay, so here we say not 1. That's when we go with the revenue, and the figure that we got, we can just go to the note straight and copy it, which is 340. So this is our revenue. So this is the amount that we actually want to see in the statement of profit and loss and other comprehensive income. We don't want to see this calculation. These calculations, they will be in the notes. And you have to show how you calculated everything to end up with the 40,000 or the 4 million. Okay, so that's what we do. Let's go to the second. So we've actually adjusted this one. Why does? How come that doesn't? Okay. So we have actually adjusted for this one. So let's just round it up to show that we've actually covered it. And here we're going to cross revenue. Okay. Then we have the cost of sales. We don't have a note on the cost of sales. So preliminarily, let's just go to the notes here. Then we say note number 2. Then we say cost of sales. These ones we are given this cost of sales. So just say given, then you put how much are we given. We are told that in the trial balance the cost of sales 246,800. 246,800. Let's just leave it like this because maybe we have actually some additions to that. We go to distribution cost, the sum plus distribution cost. Let's just take note of those ones. Where is it? Distribution costs. Okay. This one we are given the amount that is given the trial balance is how much we are given that the distribution cost is actually 17,400. 17,400. Okay, let's just leave it for like this for now. Let's go to note number 4. Okay, this was supposed to be note number 3. Note number 4. Note number 4 is saying what's next here is administrative expensive, and there is a note. Admin expenses. The admin expense that we are given the trial balance is how much? 5,500. 5,500. And we are told that over and above this 5,500 there is a note or number 2. And they are saying in the note, administrative expenses include an equity dividend of 4.8 cents per share paid during the year. We know that these dividends can never be classified as expenses because by definition, dividends are not an expense but an appropriation of profits. By the way, you have also to understand your conceptual framework. An expense, as per the conceptual framework, it says these are decreases in assets or increases in liabilities that will result in decrease in equity rather than distribution to equity participants. So this dividend is actually a distribution to equity participants, and it was specifically excluded from the definition of an expense in terms of the conceptual framework of March 2018. So we should remove this 4 cents per share that is included in the admin expense because a dividend is not an administrative expense. Okay, so we should calculate here, we should calculate how much dividend was actually included there. So we can go to our trial balance. We can see that our shares, we have to calculate the number of shares here. We are told that we have equity shares of 20 cents each, which are adding up to 50 million. So it means what? If the value in the trial balance is 50 million, we are told that it's for 20 cents. That means how many shares do we have? It will be 50 divided by the value. So we have actually 250 shares. Okay, so here the dividend was paid is 4.8 cents per share. So our 4.8 cents is 0.048. That's our 0.4. That's our 4.8 cents. So if we say the total number of dividends multiplied by the dividends per share, we have 12,000. So 12,000 becomes our dividend that was actually paid. So we should remove it in here. Just a minute. Just 30 minutes. Okay, sorry about that. So we are saying we are going to remove the dividend paid because it's not an admin expense. It's not actually an expense. So we're going to remove it. So the revised admin expenses that we are going to actually include there is equal to the 5,500 minus the 12,000, which is actually this one. This is the revised that we're going to actually include in our profit and loss account. Okay. So this is how you would do your admin. Then let's let's circle this note to show that we've actually covered it. Hey. Okay, so we have actually covered also this note. So let's round it like this. Then, so this one, we have covered it. You have to do all this, what I'm doing, in 30 minutes. Okay, we go to loan interest paid. Okay, so on the loan interest paid, you are going to note number 3. Okay, so what is note number 3 saying? Note number 3 is saying, this is note number 3, is saying the 5% convertible loan note, which is this one. Where is the 5% convertible loan note? This one. So as you can see, our interest here is reference to note number 3. Our loan also is reference to note number 3. So it's saying the 5% convertible loan note 2021, 2012, it was taken in 2012. They are saying the 5% convertible loan note was issued for proceeds of 20 million. Here our balance is how much? Our balance is actually only 18,440 now, but then it was for the process of 20 million. That means we did some capital repayments on 1 October. It is an effective interest rate due to the value of its conversion option. So we know that as an expense, what we have to calculate using the effective rate. So here, note number 5, we are going to say we are calculating finance costs here in relation to a convertible loan. So the balance here, we're told that the balance is 18. How much is it in the trial balance? It's 18,440. We charge interest at 8%. So it's equal to this one multiplied by 8%. So this is this is the loan that the interest that we're supposed to actually pay, the 1.475. But then this one is the amount that we're going to include as finance charges. But then we interest paid. We paid how much? We are told that we paid here, interest paid is equal to 1,000. So if we subtract 1,000 here, that means interest due that you are going to include under your current liabilities will be equal to the 1.4 minus the 1,000 paid. That means you will be having 475 as interest due. Okay, so this one, everything that is going to the income statement, I'm indicating that in this color, and then everything that is going to the balance sheet, I'm going to indicate it in this color, the green. Okay, so this is how we adjusted for interest. So we can cancel it. Let me just try to do something neat. Okay, so we accounted for this one, we accounted for this one, and now we're accounting for this one. Okay, so we are done with those ones. Then we have investment income. We don't have any note, so let's just leave it for now. Here we here we accounted for these notes, so we are no longer going back to these ones because we already have adjusted for them. That's dividend in that's investment income. Let's leave it like that for now. Then we have profit on sale of investments. This is now per IFRS 9 financial instruments. And so let's just put a note here. We are going to note number 6. Note number 6. Note number 6. Is what? It's about profit on sale of investments. Profit on sale of investments. Okay. So in the trial balance, we are told that it's 2.2, and in the note it's not number what? It's not number 4. So note number 4 is saying. Note number 4 is saying, during the year, Sundown sold an investment designated as fair value through other comprehensive income for 11,000. So the sales proceeds for that investment, sales proceeds for that investment is 11,000. We're ignoring the other zeros, but it's 11 million. Then at the date of sale, it had a carrying amount of 8.8. So our carrying amount is 8.8, 800. Okay, it was 800. What did I do? It was 800. Okay, so this is the carrying amount. So that means our profit here is what? Our profit here will be equal to the sales proceeds minus the carrying amount, of course. So our profit is actually 2.2, our profit. But we have other things here. We are told that Sundown has recorded the disposal of the investment. The remaining fair value, that FVTOCI is fair value through other comprehensive income. So if you remember, if you did financial instruments per IFRS 9, you remember that for financial assets or investments in other companies, you can either hold those investments through profit or loss, or you can hold those investments through other comprehensive income. What it means is every fair value adjustment, if we have a gain or a loss, we are going to add those gains or subtract those gains in the profit or loss. And the what it means is, let me just go to the profit or loss for a bit. Here we have a profit or loss. So the profit or loss is from this part. Sorry about that. The profit or loss account is from this part up to this part. This is the profit or loss. Then from this part up to this one, that's the other comprehensive income. So if we are saying we are holding a financial instruments through profit or loss, that means the changes in the value or the fair value adjustment for that financial instrument will be added here. If it is a gain, we are going to add it under other income. If it is a loss, you can actually put it under other expenses. That is if we are holding the financial instrument through profit or loss. But if we are holding the financial instruments through other income, the fair value adjustments, we are going to add those here. That's what it means. Okay, so when they are saying this financial means that we are selling now was being held through other comprehensive income, that means those fair value adjustments were adjusted here. Okay, after the profit after tax. Okay, so what does it mean? Okay, so the fair value adjustments will be classified as equity. Okay, so the fair value adjustment, if you are holding the financial instrument under through other comprehensive income, those fair value adjustments will be appearing as equity. Okay, so when we now sell, we actually made a sale of those investments. We say we have realized, we have actually realized oh, my timing is running out. Okay, I'm just going to stop a little bit.